Hello everyone. I will continue with the rest of chapter. So here we look at some of the merits and demerits of state and federal regulation. Those who support federal regulation in place of state regulation have the following reasons. State federal regulation will lead to uniformity in regulation across the country. The US will be in a better position to negotiate in international insurance agreements. Federal regulation will be better able to identify and treat systemic risk, and insurers will become more efficient if they face uniform regulations across the country. Those who support state regulation, they have the following reasons. State regulation is more responsive to local insurance problems. Federal regulation will lead to dual regulation and increase the cost of doing business. Federal regulation does not have a good track record because it has not been able to manage or prevent banking crisis. And uniformity in laws can be ensured even with state regulation if the states follow the model laws prescribed by the National Association of Insurance Companies. So these are some of the advantages of state regulation as per their supporters. What are some of the drawbacks of state regulation? It is not able to protect consumers and hence is also not able to address their complaints properly. It is not able to investigate market conducts and ensure proper regulation in this regard. It is not able to make insurance readily available or extensively available. Another problem is the conflict of interest. Many of the state regulators have worked in the insurance industry previously, and hence they are more favorable to the insurers. Another debate is whether the McCarran-Ferguson Act should be repealed. So those who support federal regulation say that the insurance industry does not need exemption from federal laws. Rather, federal regulation can help overcome some of the defects in state regulation. Those who support state regulation say that the industry is already competitive and small insurers will be negatively impacted if this law is repealed. So the law basically states that insurance is a state purview, and only in places where state regulation is not there, the federal laws will apply. Now we look at some of the emerging issues in insurance regulation. The first aspect is the Dodd-Frank Act of 2010. So it created the Financial Stability Oversight Council and the Federal Insurance Office. The FSOC is supposed to look at systemic risk and classify non-banking companies which are systemically important. If any insurance company is identified as systemically important, it will be subject to more strict regulations and also be regulated by the Federal Reserve. The Federal Insurance Office monitors all aspects of the insurance industry. It tries to identify gaps in insurance regulation and helps to identify systemic risk. It also assists the FSOC to identify insurers who may be systemically important. It also represents the US government in international insurance regulation. The Dodd-Frank Act mandated the FIO to come up with a report on insurance regulation. The report that they produced suggested a hybrid model of state and federal regulation. It said that federal involvement is required in several areas, and there is also need for improvement in the existing state regulation. The FIO also represented the US in agreements with the European Union. The idea was to make doing business in the respective jurisdictions of insurance companies from the other jurisdiction. Another consideration in insurance regulation is federal charter. So those who support federal charters say that national level insurers, those who operate in different states, they are at a disadvantage as per the state level regulation. So it will benefit them. And those who oppose the federal charter, they say that it will lead to additional regulation and increase the cost of doing business. Now we look at some of the issues pertaining to insolvency. So ensuring that insolvency does not happen is a very important aspect of regulation. Insolvency can happen in case of inadequate rates, inadequate reserves, mismanagement or fraud, bad investments, and so on. The Solvency Modernization Initiative was started by the National Association of Insurance Commissioners. So it was a self-examination of many solvency requirements in the US. So some of the key areas which it looked into was capital requirements, risk management, corporate governance, reinsurance, and so on. So how is solvency ensured? So the regulation mandates minimum capital and surplus requirements for risk-based capital. There are restrictions on investments. There is also provision for review of annual financial statements. So these are some of the ways in which regulators keep an eye on insurance companies and ensure that they remain solvent on a long-term basis. There is also some issues related to market conduct, that is sales and distribution of insurance policy. So it relates to sales, advertising, underwriting, collection of premiums, and so on. So the regulators have to be proactive and ensure that the industry practices does not have a adverse impact on customers. This can happen through sale of unsuitable products, misinformation, rates that are excessive or discriminating, then denial of claims. These are some of the problems in terms of market conduct, which the regulators need to be careful about. The Federal Insurance Office created a report with recommendations for market conduct. So they said that that every state should participate in the Interstate Insurance Product Regulation Commission. And they should also adopt the suitability in annuities transaction model regulation. The final aspect is credit-based insurance. There is also a trend among insurance companies to determine premiums based on the customer's credit history. So basically, insurance companies refer to the customer's credit history for underwriting purpose. Those who support this practice say that there is a strong association between credit history as well as the future claims of the customer. Also, referring to the credit history helps the insurance companies to decide on suitable premiums for high-risk customers, which otherwise would not have been possible. And most customers have good credit scores, and hence they benefit from credit-based insurance. Those who oppose this initiative, they say that credit history is used to discriminate against minorities and other groups. Another concern is that during recessions, many consumers may face a drop in credit scores, and it can adversely affect their insurance policies. That is why many states have enacted legislations to regulate the use of credit-based insurance. That's all for Chapter 8. Thank you.